Right, hello, and welcome to today's podcast. It's Monday, the 10th of July, 2023. My name is Adrian Boothie. I'm the head of trading here at TrendSignal, and as ever, I'm joined by Jerry Miller, the managing director here at Trading and TrendSignal, and our chief market analyst. So, hi, Jerry, how are you?
Yeah, morning to you, Adrian. Morning, all.
Great. So, as we do in these podcasts, we sort of take a look at, what's happening from the previous week. What do we know? What's likely to happen for the next week, and then also a couple of other things. We'll look at some markets. We'll talk about a problem that's quite common to a lot of traders. But let's start off with what do we know? So this is where we take a look at what's happened over the last week or so since the last podcast. So Jerry, take us through some of those headlines, please.
Yeah. Well, another key week for markets last week. The non-farm employment change, which is the curiously named employment report in the United States. The reason why we're interested in this non-farm employment report is that unemployment, or the employment picture, affects what the Federal Reserve, that's the US central bank, what they do with interest rates. Because unlike most central banks, the Federal Reserve actually has two mandates. So it's has to maintain price stability, that's inflation to you and me, not doing a particularly good job at the moment, but none of the central banks are. And the second mandate obviously is to foster full employment, which basically means if employment is very tight, that will affect what the Federal Reserve do. If unemployment is very high, it'll also affect what the Federal Reserve do. So that's the reason why we're interested in it. And last week was the monthly release of this data called non-farm, and that's the reason why, well, we had a bit of an interesting move. But before I actually get on to the US markets, I just wanted to kick off with the European and the UK markets, which had a torrid time, Adrian. 270 odd points. If you want to show the FTSE one and UK 100.
FTSE got a bit battered, didn't it? And why would that be? Because it had such a bigger fall compared to the other indices. That's literally just down to the makeup of the stocks that are within there, right?
Yeah, it's got what we refer to as a number of unloved stocks in unloved sectors. So if you think about it, the oil sector with BP and Shell, two huge stocks that make up the part of the FTSE 100. Then you've got the miners, some of the underperforming banks as well. It's a bit of a hodgepodge, and I think that's one of the reasons. But we weren't alone with the FTSE 100. The DAX fell close to the same amount, 3.4%, 545 points last week. So really, it's just hitting all sorts of ghastly lows. The FTSE, I think it fell 3.65%, and it but it wasn't just the FTSE 100, it was a 250 as well, which is when I like to talk about the prospects for the UK markets, we tend to focus on the 250. It's not something we trade, but that's sort of more representative of the UK PLC, and that fell to levels last seen in October last year.
And I think that's because the FTSE 100 is largely based on more global companies, right?
So yeah, that's right. That's exactly it. There's lots of companies on the FTSE 100 that have never been near the UK, apart from the head office, of course. But you've got some of the big miners and stuff. They've got no interest in the UK whatsoever. And but that's been the makeup of the FTSE 100 for quite some time. So there's nothing new here. But I think it's just been clobbered. And I think the 250 is suffering now as well. And it's all to do with the interest rates, the prospects for even higher interest rates. Every time we hold these podcasts, I end up referring to interest rate expectations. And 4 months ago, we were talking about interest rates hitting 4.7% by the year end. Even then, I remember thinking, oh my God, that's going to really put the cat amongst the pigeons. Well, guess what? They're not, it's the cat amongst the pigeons, but everything's amongst the pigeons. It's 6.5% now, Adrian. That's where we're expecting interest rates to go. Not by the end of this year, but by the end of Q1 next year. So the whole thing has really been dragged out, pushed out further. And that's because the prospect for inflation here in the UK is not looking good.
So what does that mean for the markets generally? Are we sort of in, does that mean, so obviously I guess we're looking at risk off in a way to for indices, aren't they? They've definitely taken a bit of a hit. But what about the currencies? What have been the moves that we've seen because of that?
Well, that's something that has been factored in for some time now, but it'll be factored in even more is the strength of sterling. And when you look at what sterling's done against the dollar, it must have rallied about 1.5 cents last week against the dollar. And
Yeah.
then you can look at it against sterling, against the euro. Sorry. So if you look at euro sterling, this is the old the weak currency of Europe. It's not looking weak after all. And if
Yeah.
you scrunch the chart up, Adrian, and look back, I mean, look where we've come from, 90. We're currently trading at 85, 60 or something. And
Yeah.
it's been even higher than that. So this is quite a turnaround, and it's largely down to interest rate differentials. So what we mean by that, Adrian, is interest rates are likely to go a lot higher here in the UK compared to Eurozone interest rates that are set by the European Central Bank. And that means, investors and traders will put their money where they can get the best return in good old sterling accounts here in the UK.
Yeah, interesting. Okay, so can we just take a quick look at the non-farm payroll data? Something that I thought was quite interesting. Perhaps you can comment a little bit more. We had the ADP data come in on Thursday last week, 497,000 jobs versus 226, and yet non-farm employment change it was slightly lower than expected. So, can you just explain what the difference between these two readings are? Because they seem a bit conflicting, really.
Well, they are conflicting, but one is produced by a payroll company called ADP. So ADP release monthly data, a bit like the Bureau of Labor Statistics that release the official statistics on the Friday. ADP are a payroll company, and they've got an insight into the number of jobs being created or destroyed or lost in an economy, because that's their job, is to process payroll for companies throughout America. So they've got a pretty good handle on what's going on there, but it's quite volatile, and the data should be looked at, very at arm's length, as it were. Don't get too involved in the detail. But after that number came out, the 497,000, expectations for non-farm went up, and there were rumors on Friday morning that non-farm employment change was around 350, and the markets had got a little bit jittery ahead of it all. Well, in the
And
end,
why would that be? Just explain that, because that's going to be inflationary, presumably.
yeah, because so if the new number of new jobs continues to be very strong, it basically makes the Fed's task of reining in inflation even more difficult. Now, to be fair, core inflation in the United States is a lot better than it is here, but with a strong labor market, it's unlikely that core inflation is going to go down to that 2% target that the Fed have anytime soon. Um, Fortunately for the markets, the rumours were unfounded, and the number came in, as you pointed out, at 209,000, which was less than expected. But what was really interesting is that not many people picked up on this, but the number of new jobs for the previous 2 months, yeah. So we're talking about, so this is the report for June, published on the 7th of July. The report in June for May, and the report in May for April, they were revised down by 110,000 jobs. So actually, the employment picture doesn't look quite as rosy as some might have thought, which totally conflicts with the ADP data. But you'll find a big revision in the ADP data next month, I can guarantee it. Well, I won't
Yeah.
guarantee it, but that's likely, is what I mean.
Yeah, that's really interesting. Although, I mean, one thing that we can note is that the average hourly earnings have actually increased. So despite not as many jobs created and so on, that's kind of inflationary there, isn't it?
Yeah,
Really,
yeah,
that
yeah, it is, and that's something that the Fed will be looking at really closely. It was a bit of a spoiler, to be honest, Adrian. That otherwise the data was pretty positive for the markets. Not positive if you're looking for a job, but in the United States. But the spoiler was the average earnings, which came in at plus 0.4% rather than plus 0.3%. But we like to think of things, on an annual basis, because that's how a lot of us reference things. But that puts annual wage inflation at 4.4% rather than 4.2%, which was expected. So it's still, I still think the dial hasn't really shifted much on the outlook for interest rate expectations. So, the Fed Watch tool from the CME, Adrian,
Yeah.
If you click on that, you can see that it hasn't really shifted much at all. If you go to November, it's currently standing at around 40% when you look at both 5.5 and 5.75. The probability 40%, I think that hasn't shifted since before the non-farm payroll. And for the 13th of December, I think there's a slightly lower probability of a rate hike. But this contrasts with the dot plot from the Federal Reserve at their last meeting when they said they'd be raising rates twice by the end of the year. So one of them's got to be wrong.
Yeah. Well, as we've seen, just doing these podcasts literally over the last couple of months, that very often it's the forecasters that tend to be getting it wrong. The Fed are really sticking to their plans, really, and it's but I think we have rose-tinted spectacles probably in the market, and hoping there won't probably be as many as rate rises as we might like. It's a little bit like a profits warning in a way. It's like it's like, well, we think the profits are going to be really bad, but maybe they won't be quite that bad. So they will often come in threes, don't they, with profit warnings, because nobody really likes to face up to the fact of just how bad things might be, and hopefully it won't be quite so bad. In a way, I kind of feel like the market's doing a little bit of that.
Well, the market's been in denial, and it's almost out of hope than anything else. But if you think about what the stock market has done so far this year, it's not a bad outcome, bearing in mind interest rates are going to be going up to 5.5, possibly 5.5 by year end. That is not normally compatible with a strong market like we've seen from in the US.
Well, it's odd, isn't it? Because we've done many podcasts in previous years where we talk about Tina, there is no alternative for your money. So what do? You stick it in the stock market because putting cash in deposits just earning you absolutely nothing. Well, that's not really the case anymore, and yet the stock market is still going up. So does that mean, are we sort of buttering ourselves up for a big stock market fall? Potentially, when suddenly you start to get Q3 earnings or Q2 earnings coming through, and we're going to move into the next quarter, if people are having less money, that's going to start to fizzle. That's going to get its way through into corporate earnings data, surely.
Yeah, I mean, we discussed this last week and the week before as well, and I think the market breadth, where only a few mega stocks or super tech stocks are responsible for these massive gains that we've seen in the NASDAQ, something like 33% this year. Well, it won't be any more, but just extraordinary gains that is not replicated across many other tech stocks. But it's those big ones, the Microsofts, the Nvidia, Amazon, Apple. Apple above $3 trillion last week. These are big moves, but it does mean if these stocks do turn tail and start falling, it'll drag the whole index down almost as quickly as it's gone up.
Yeah, so in a way, the indices aren't always so representative, are they? Particularly if you've got a small number of stocks which make up such a significant proportion of it. I'd be interested to see. I don't know if you know that. You take those top 5 or 6 stocks, what percentage of the S&P that actually is by market cap?
It's huge compared to, we're talking about 6 or 7 companies, and I think you're talking more than 20% of the market cap, maybe even more than that. I mean, look at Apple. Apple is worth more than the whole of the FTSE 100.
Yeah, it's insane, isn't it?
Yeah.
Okay, so let's have a think about next week, or this coming week. So we're Monday the 10th of July at the moment. We've got a few bits coming out. What are the sort of top 2 or 3 events this week, Jerry?
Well, undoubtedly the US inflation data on Wednesday. We've just been talking about the need to raise rates in the States because core inflation hasn't come down, et cetera, and the markets are pricing in less than what the Fed are saying they're going to do. So that data out on Wednesday will be so keenly anticipated. Comes out at 1:30, as you've highlighted with that arrow there. We're expecting the key one is actually the core rate, the one you'll highlight, that's the one. So this is the core one, and the difference between core and headline, the core one, it excludes those volatile components such as energy, crude oil, gas prices. Remember, they went up by a factor of 8. They've all come flying down, but now we're left with the core rate, which excludes those volatile components. And what we're left with in the core rate is the sort of endemic, the built-in inflation rate in every economy. Because energy prices have come back down and food prices will come back down. And we're looking at something that is become more persistent than we would hope. I mean, in the UK, it's a bit of a nightmare. We're right up there about at 7.1%. Last month, the headline rate, the core rate, I should say, in the US was 5.3%, and we're expecting it to fall to 5%, which basically means the month-on-month reading falling from 0.4% the previous month to 0.3%, which is where your arrows pointed. So an improving picture, but it's not 2%, Adrian.
And it's not improving probably as quick as anybody might expect, maybe. And what about the impact on, say, the dollar, for example? So if that number comes in at higher than 0.4%, that's going to be obviously it's inflationary, right? So what would we expect?
The dollar would rally on the back of that, because interest rate expectations would harden up, and with greater expectation that rates will be going up 0.5% by year end, traders and investors will flock to the dollar. That's exactly what will happen.
So just for those listening, the idea being that if you're trading a market where the US dollar, like a currency market, where the USD is priced first. So for example, USD/JPY, USD/CHF, USD/CAD, you'd expect those prices to rise. But where the USD is listed second, like euro dollar, pound against the dollar, Australian against the dollar, you would therefore expect those markets to fall. And of course, the opposite being if it comes in lower than 0.3, basically.
Yeah, it's a pivotal number. And remember, we've got that Federal Reserve decision. It's not coming anytime soon. I mean, we were just looking at it. It's on the 26th of July.
26th, isn't it? So another 2.5 weeks or so, yeah.
Yeah, that's right. But plenty of time for the market to digest the implications of a strong CPI number, if that is the case. But just bear in mind, their target is 2%. And there are commentators saying, well, it's like an oil tanker. We should be stopping raising rates now, because the effect sometimes takes anything up to 15 months for it to be felt by the economy. I think, as we discussed last week, it's almost certain that central banks will probably have a misstep in their policy, and they'll probably over tighten in the current tightening round. But they've got little choice, because they get vilified in the press if they're not raising rates when inflation is still going up or is stubbornly high.
Well, absolutely. And then otherwise, we've got a couple of central banks this week. So we've got the Reserve Bank New Zealand, which is on Tuesday night, small hours of Wednesday morning, expecting no change there. Important for New Zealand dollar positions, everybody. So if you're trading something with New Zealand dollar, so for example, we've got a potential buy opportunity on pound against New Zealand tonight. You need to be thinking about that position as you move into Tuesday night. Do you still want to hold it over that trade? A risk-averse trader would look to close out. I certainly would. But then I am quite risk-averse anyway, naturally. And then we've got the Bank of Canada on Wednesday at 3 o'clock as well. Jerry, expecting a quarter-point hike there?
Yeah, just they've rather fooled us last month when we're expecting no change, and they came in and raised rates, and that really set the tone for the week, actually. And you had our own Monetary Policy Committee also raising rates by 0.5% later on, and it did affect other markets. It's unusual for the Canadian central bank's moves to affect US markets and global markets as well, but that's because it was a surprise. But I think everyone's cottoned on to the fact now that inflation ain't coming down as quickly as nothing like as most analysts expected, and for that reason, rates are going to have to go higher and probably stay higher for longer.
Yeah, I think everyone was sort of sitting there hoping that it would be this transitory thing and we'd be kind of done with it by now, but it's just not really happened. So interesting. Okay, Jerry, I think that's pretty much it. Anything else to add? Anything else we need to be mindful of?
No, I think we've gone through most of the key ones, Aidan. That's fine.
Okay, Jerry, that's great. Well, thank you very much for that, as ever. Definitely put those dates and times in your trading diary for this week ahead, because they will be important. They will create movement and maybe create some reversals in the marketplace as well. So thank you very much for your guidance there, Jerry.
Okay.
Okay, so let's have a look at what else we want to be talking about. Let's have a quick look at some of the markets. I'm not going to spend too long on this one. There's some interesting opportunities over the last sort of week or so. Certainly more opportunities than we've had over the past few weeks, which has actually been a bit quieter. So I think June we had 33 opportunities on the D1 sniper strategy versus an average of 48. So it's quite a significant difference, about a 33% lower or so than the average. And what about now? Well, last week we had loads of trades coming through. It's like they've been all been stored and waiting for last week. Overall, small up on the week. Last week, 1 or 2%. We had an opportunity on Aussie yen hit target on us from Friday's close. But equally, we had a loss-making trade from it earlier in the week as well. So we, sort of 6 and 1, half a dozen of the other maybe. But a nice profit on that one from Friday's close, going on and hitting target. As Joe mentioned earlier, one of the sort of big stories has definitely been those indices. The FTSE 100 really being the biggest mover of them, I would say, in terms of the short trades, getting onto that trade from the 5th of July, a number of other opportunities entering more on the 6th of July after a lot of the market had already turned. So, but getting a decent chunk on that. That was about a 2.4% winner there on the FTSE 100. But otherwise, we're in quite a few trades and we're just sitting there waiting for those to sort of pan out. So up on a few, down on a few, that sort of thing. Bit of a mixed bag, but some nice opportunities, particularly on those indices. One thing that I have found quite interesting at the moment, and we're going to talk about those now, is the potential for maybe some trend reversals kicking in. And I think this is worth having a quick look at. These are the pink snipers that you'll see on the charts. You can see, first of all, we go to Australian dollar against the Japanese yen. You can see that first one here. And what you're seeing on this chart is what has happened is the market's been ratcheting its way higher with higher uptrends on the weekly, uptrends on the monthly. And now, look, if you're going to start to see a downward pattern, you need to start to see lower highs and lower lows. The monthly charts, the weekly charts, they're going to turn down much more slowly. But when you can start to see signs of a trend changing by, instead of the market putting in higher highs and ratcheting its way higher, you're going to start to put in lower highs. You've got a high there and you've got a lower high there. That's kind of what we're seeing here, is that point there. So in order for the market to reverse at some stage, it's got to start putting in lower highs and lower lows. That seems to have started on a number of markets. Does that mean that we're starting to see a bigger trend change unfolding? I don't know. I think it's probably a little bit early to tell, but certainly there were quite a few pink snipers over this week. And you're seeing there the market ratcheting its way higher, but all of a sudden the failure of its ability to break to new highs. It has been breaking to new highs convincingly. It didn't do that here. It stopped, reversed back the other way, and gave us a short. So it's starting to break to new lows now. And let's have a look at this in terms of some of those other markets. It was the, let me just have a quick look. I need to remind myself what it was. The Nikkei, very much one of those. Again, moving higher, no buy sniper there, but moving higher, but again, lower than the previous high there, coming up with another pink sniper. And there was, again, there was one more as well, which I'm going to struggle to remember, but either way, I find it quite interesting really at the moment. So there's one other market, but what it is, a number of those markets, strong trends kicking in, early warning signs of the market starting to shift direction. And what you've got to remember is that there's an element of correlation with these markets as well. And we're going to talk about that in the problem in just a second. So just to give you a quick review, we've still got one trade open for the D1 Sniper. D1 Sniper for June, this is for June, like trades that opened in June. How has June gone? We were up 6.4% in June for the D1 Sniper strategy. The D1 Accelerator up 12.3%. One trade still open on the D1 Sniper. It's currently small down, so we'll probably finish at around sort of up 5.5%, 6%, something like that. But overall, a good month for June, and pretty much flat at this point for July, with some decent, a few decent trades coming through as well. Let's have a quick look through then for the problem there. So I'm kind of out of kilter there really with the slides, but what's the problem? I'm going to talk about correlation just very quickly. In this section of the podcast, we take a particular problem that a lot of traders have, and we talk about how that might be something that we can sort of look to get around. correlation is definitely an issue. And that happens with traders and investors. How might it look for investors? Probably having too many stocks in the same sector. So if your portfolio is overweight, so i.e. too many in that sector, on say resource stocks or mining stocks, oils, banks, and so on, that basically gives you the it means your portfolio is going to be more volatile. They're more volatile stocks anyway, but also they're going to if the economy starts to look a little bit more worse for wear, then they're going to come off very, very quickly. So what you can have is a much faster portfolio, which is okay to the upside, but not so good to the downside. So if you're going to be a bit more risk loving, at least be informed about that. So when you want to look at your trades, you want to be aware about what sort of correlation there might be. And when you think about correlation for Forex indices and commodities, it's very much that sort of risk on or risk off play. What does that mean? Risk on means when you're putting risk onto your portfolio, i.e. Pension funds, hedge funds, they are adding risk. They are risk loving. So what they're doing is they're loading up on instruments that are more likely to prosper when the market is, doing better. And then you'll have a risk off mode, and what that activity might be. So risk on might be, right, we're going to buy stocks. They're riskier assets. We think the economy is doing quite well. We're going to add riskier assets onto our portfolio. You're probably then going to buy certain currencies like Australian dollar or the New Zealand dollar, largely because a lot of those are more commodity currencies, right? So you're going to go onto those sorts of currencies and probably steer away from the safer ones like the dollar, because you're happy to take on an element of risk. And then when the market's moving back the other way, you suddenly see equity markets fall. You'll then start to see all other things being equal, the dollar rise as people flood their capital out of stocks and then put it into what they might see as a safer currency. So always be aware of that degree of correlation. And that's why, what you'll find is certain trades will appear at certain times, right? So we had quite a lot of trades last week because a lot of those markets are looking to turn at a similar sort of time. So be aware of that. And that's one of the reasons why you'd risk 1% or 2% of your account on each trade, something like that. Really no more than that, just to make sure that when the markets do change direction or something doesn't quite go to plan, then you're not too exposed in your broker accounts. Okay, so be aware of correlation. Look up the term risk on and risk off, what that means to you for your portfolio. And what that can mean to you is when you're loaded up in too much in one way. So let's say you're long 3 or 4 indices, you're long some Australian dollar pairs, you're long some New Zealand dollar pairs, you might want to think about whether you've got too much in your account exposed to the same type of move, and you might want to look to reduce some of that risk accordingly. Okay, and again, that's up to your own aversion to risk, of course, but hopefully that's useful. Otherwise, everybody, thanks very much for listening to this week's podcast. We wish you every success with this week's trading. Hopefully you make some decent profits, and we'll see you next time. Bye for now.